Good afternoon and welcome. Today we'll be taking a look at global financial markets and investing related topics with a specific focus on April of 2020. This call is for informational purposes only and may be recorded. Statements made during this call are the opinions of the speaker and are subject to risk and uncertainty, some of which are significant in scope and by their very nature beyond the control of WealthFactor. There can be no assurance that such statements will prove to be accurate, and actual results and future events could differ in a material way from said statements. Historical results are not necessarily indicative of future performance. For those of you who do not know me or don't know me well, my name is Bill Woodruff. I founded WealthFactor in 2017. I have over 20 years of investing related experience. That really started out prior to the tech bubble bursting in the late 90s. My investment career is diverse. Done trading for a hedge fund, done manager research and due diligence across a variety of manager types. I launched and managed a mutual fund as well as other fund types. That mutual fund business line was acquired by a public company. All of that has led to WealthFactor. So WealthFactor is a Lake Oswego-based investment advisor. We provide custom plan-focused investment advice. We offer that service through managed custom portfolios, predominantly index-based. Our client accounts are held in their individual names at a third-party independent custodian. We charge 0.35% on assets for our full investment advice service, up to 10 million, 0.1% thereafter. We also offer a advice light service, which is our direct indexing. So to give maybe just a quick top level feel of how we think at WealthFactor, our philosophy we call risk smart, and there are three key aspects to risk smart: being portfolio smart, or another way to think about this is being structurally efficient. For us, that's really about avoiding things like picking and timing. It's my belief that it's difficult, if not impossible, to outperform indices or markets gross of fees, and then once you add layers of fees, increased fees, the probability just continues to go down from there. Another element is avoiding layers as well as complexity. I believe both of those things lead to additional fees and costs and ultimately increased risk taking, which is in nobody's interest. The next element is fee smart. We charge 0.35%. And then by utilizing index-based investing, we're really not layering on a dramatic additional amount of costs or fees. Being fee smart or fee efficient, it's my belief that it makes sense to pay for investment advice and investment related services. But after a certain point, those increased fees and costs will start to be a detriment to the probability of success. The last element is tax smart. Our direct index-based investing allows for a significant amount of individual account specific tax optimization, whether that's through strategies such as gains deferral or specific tax loss harvesting strategies. What am I going to go through today? Well, April was a month that I think a lot of people weren't expecting. Q1 was clearly a surprise as well in a lot of ways. In terms of our clear impacts to the global economy and the U.S. economy from those forced isolations. In April, we saw the markets snap back dramatically, and I hear a lot of people asking the question, why is that happening? Where it's clear that there's going to be real issues going forward for the economy. So today I've identified 5 different elements I'm going to spend some time on. The first element, which is persistent in equity markets, is markets move and price things in very, very quickly. Perhaps there's a case to be made that's happening faster than ever before. That certainly can be, there's certainly some evidence that might point to that, at least as a single data point in the first quarter, where we saw the most rapid decline in prices historically. So the second element, in terms of why was April such a strong upward movement, why do we see such a strong upward movement in prices? Swift action by the Federal Reserve Bank. Number 3, swift action by the federal government. 4, we saw, especially after the first week or so of April, evidence that suggested that social distancing practices were in fact flattening the curve and perhaps reducing the extreme negative outcomes that were feared in the first quarter, the end of the first quarter. And then lastly, 5, also was supportive to price increases in April, was optimism that there might be a cure or vaccine for the coronavirus, ultimately leading to maybe a reduction in the fear or risk that we might have this be a perpetual challenge or issue. So, the most important one here, though, for me, is when equity markets declined 30+% in the first quarter, that was pricing in an incredible amount of negative future potential. That unwound a bit as we saw prices go back up. And then lastly, I'll look at today performance. I consistently believe that we shouldn't read too much into short-term moves in prices. And so I typically, whenever I share performance or information, will look at it in a longer term context. I'll start off with swift action by the Fed. The federal government's actions really took center stage in the media and most people's focus. But the Fed did its part and did so really quickly, restarting unlimited asset purchasing programs and including assets that it did not include in the financial crisis, most notably ETFs for corporate investment grade bonds. As we look at and try to answer this question of, why was April such a strong period? Well, things were very scary at the end of the Q1, and then in a very short amount of time, there is a significant amount of support that's coming behind asset prices in general. Unlimited asset purchasing program certainly leads the way here. But they're restarting TALF and other various different facilities to support financial markets. And then also, another thing that's worth noting, and it's not necessarily Fed specific, is that the average bank or a balance sheet is in far better condition, or was in far better condition going into this, whereas the banking area or sector of the world was really at the root or cause of the problems for the financial crisis. Different situation. There's really no lag in response, unlike the financial crisis. So number 1, swift action by the Fed. Swift action by the federal government. There's a clear potential interruption to growth, and the federal government steps in with an enormous amount of financial support. Of course, that's going to be clumsy. You can't do something with an incredibly complex economy on very short notice that's not going to have some issues. And there's been some missteps, but generally, $2.4+ trillion being injected into various different elements of the U.S. economy is going to be supportive of price in riskier assets in general, and supportive of the economy, at least in some way in the short term. It's to be determined what the long-term impacts of this sort of thing are, or the thing that we might be observing over time. And it's just 2 data points, I guess, so far, right? With the financial crisis and now this coronavirus-linked situation, is it's probably a net positive for whether it's the Fed or the federal government to step in and be that backstop to make sure our financial systems continue and we remain confident in our system, so that we can go and do what the U.S. has always done, which is go out and innovate and work hard. And so there's some additional data in here that's interesting. Puts that amount of stimulus into context relative to GDP. So 2.4 trillion is approximately 12% of GDP. That's an enormous amount. And another on this top right graph, I think is pretty interesting. Once you get past 2020, these are forecasts, right? Which there's always going to be some uncertainty around that, but that shows the deficit levels considering this incredible amount of stimulus. And then on the bottom graph here, it's showing some context around estimates, future looking, for what debt looks like on a relative to GDP basis. These elements may have an impact on these short-term fixes. The point number 3 is coronavirus curve flattening. Again, markets move really quickly, and so in tail end of the first quarter, they were pricing in some really scary outcomes for the coronavirus. And so after the first week of April, as the pace in which the coronavirus number of confirmed cases and fatalities started to flatten and perhaps even decline to some degree, that was a relief to markets and asset prices in general, and was treated as a positive. Again, markets price things in really, really quickly, really builds on the case that investors should attempt to avoid making decisions in the short term from an investment perspective and relative to how they think about the future, largely because of how fast asset prices are factoring in the information that we think we know. The last element I'll spend some time on today is looking at some of the returns. And the biggest thing that I think that's worth spending time on is the continued divergence. And it's been 10 or 12 years factor or style-based divergence in prices. And so a lot of focus is on the S&P 500 or the Dow Jones. Well, those are really a subset, while they're the largest companies and represent the largest parts, the U.S. stock market, there really are quite a few other elements and thousands of other companies that aren't included in that. What we've seen is large and growth-oriented companies really snap back really quickly from a performance perspective. And if you look back over the last 10 or 12 years, those are the sorts of companies that really led the very strong performance. And we continue to see, whether it's, and if you go to the opposite end of that factor spectrum to small and value, you see small and value really lag over the last 10 to 12 years. And then, also is still, negative significantly despite what was very strong performance. And so this top left group of data here shows the performance for April, even though it's listing quarter to date. April is the entire second quarter so far through the end of April. And you can see there's a strong recovery across the board, but you can see even including that recovery where large growth is almost back to even. Large blend, which is a better representation of the S&P 500, is still down almost just about 10%. Other areas of the market are notably off quite a bit more on a year-to-date basis. And that's, there's a logic behind that, right? Where, smaller companies are not going to have the significant economic resources to continue, or more of them are going to come under strain or stress in a prolonged period where there's a reduced or eliminated amount of economic activity. So I persistently don't think investors should focus too much looking back on performance. I think that the highest probability of success is attempting to ignore this information. Can we draw some longer term conclusions? Perhaps. More so, I think that's just reminders of what not to do. And as I think back on the last 20 plus years, really investors have been rewarded by not chasing after what did really well yesterday. So if anything, I'm looking at a portfolio today and saying, I want to be neutral in terms of my growth, my large growth versus my small value. And it's not the time to be ignoring the areas that perhaps haven't performed as well in recent past. Well, I appreciate you guys tuning in. I'm going to intentionally keep these monthly updates short.